Hi, everyone, again. This is Cathie Wood, ARK Invest CIO. And we're going to be doing these stay at home or working at home with Cathie until we're through this crisis. And the reason for that is we'd like to keep you updated on what we're seeing, the promising signals, the not so promising signals, and to update you on our thinking as it evolves, as it certainly will in this dynamic environment. So I'd like to start out with some good news that we got this week, and you can find out about what we're thinking in great detail. If you click below, you'll see an icon which will take you into a Q&A webinar that we did yesterday. And it wasn't just with me, it was with Professor Arkin from Hebrew University, who described the evolution and his thinking about the flu virus. He's an expert in flu viruses. You'll hear from Art Laffer and his thinking about the fiscal and monetary policy moves that we've been witnessing over these last few weeks. You'll hear from more detail my thoughts, but they've even evolved over the last day, partly because of thinking things through in the context of what Professor Arkin and Art said. And then finally, you'll hear Brett Winton talk about innovation as it applies to, importantly, to a period like this. So first, the good news. In the last week, I think there have been more than $110 billion of bond issues in the United States. In other words, the markets are working. The markets are not seizing up. This is not an 08-09 period. And specifically, two companies were able to issue bonds, two companies at the epicenter of this crisis. So Carnival Cruise Lines and Yum Brands, which owns Taco Bell, Pizza Hut. And so we witnessed what happened around those issues and saw that not only were they able to do the deals, but the orders for their deals. Now, the coupons were pretty high. In the case of Carnival, the original coupon was 12.5%, but the demand was so high, I think it was 4 or 5 times higher than what they actually did, that they upsized the deal and cut the interest rate to 11.5%. So that's a really good sign that markets are working and that companies who are right at the heart of the turmoil are able to gain financing. So that's the good news. The other good news is we're seeing spreads, high yield spreads and commercial paper spreads relative to riskless treasuries. We're seeing them, those spreads come down. Now they're not collapsing. So there's still a lot of uncertainty out there about who's going to go bankrupt and how much this fiscal package will prevent bankruptcies. That the improvement is slow, but it is happening. So that's also good news at the margin. The bad news, of course, is we're getting these horrendous statistics. Today, the employment report, more than 700,000 people were knocked off non-farm payrolls. Expectation was for only 100,000. Given the claims data we've been seeing, I would have expected more than 100,000. But it is true that the survey was taken in the second week of March. So we were approaching the worst day, which was March 16th, but the survey was taken right before that. So you can see how many employers were really, I guess, out of fear, laying people off. And subsequently, we've seen the claims, initial claims, 10 million in the last 2 weeks. So quite a dramatic shock to the system, to be sure. So the question is, are we in a depression when, and we're going to see these statistics for the next month, 2 months, maybe 3 months. and we'll get fears, I think, from time to time that, my goodness, are we able to control this thing, or is this going to become, are we going to unravel and end up in a depression a la the 30s? And our opinion on that, our judgment call, is no. First of all, in the Depression, the Fed and fiscal authorities were tightening, entering the Depression, and continued to tighten, I believe, as they were legislating the Smoot-Hawley tariffs, which tipped the economy over into depression. Right now, we are easing fiscal and monetary policy. Some would say, if you listen to Art Laffer, way too much. But I think our fiscal and monetary policy authorities they're throwing everything they have at this because the shock has been so sudden and so severe. So we do not think we're going into depression. In fact, if you think about tariffs, I believe this week, except for China, President Trump has deferred tariffs from much of the rest of the world through the end of the year, if I'm not mistaken. There has been some relief on that score even. We are likening this period not to the Depression and not to 08-09. This is not a financial crisis. It didn't start from the financial sector. It started from the healthcare sector. And so this is not a traditional economic crisis. It's a shock to the system. Now, we've seen two shocks to the system in my career that feel somewhat like this. In fact, if you combine both of them, that's probably what we have here. The first was in 1987 when portfolio insurance failed. Portfolio insurance failed, and we thought it would, actually. Anyone looking at it and reasoning through it was saying, this is not going to work if everybody tries to get out the door at the same time, which happened on Black Monday in October of 87. So that insurance failed, much like the low vol strategies and risk parity strategies have failed this time around. So that's been a big shock to those who thought they had low volatility strategy and have been forced out of those strategies. And so that's one kind of shock we feel that we're going through. The second shock is that we experienced was 9/11, which did shut the economy down very suddenly. And there was a tremendous amount of fear around terrorism and our safety. This fear is also about our safety. It's a healthcare fear. And I think that we're shutting the economy down much more dramatically than we did back then because of health concerns. So we combine those two crises and shocks to the system. That's probably what we have now. Now, the difference between then, those two episodes, and now is the government has worked very swiftly to and reacted with stimulus or relief. They're calling the fiscal package relief package. And that's unusual. The government doesn't usually work this fast. It didn't work that fast in 08-09 for sure. And so if you listen to Art Laffer, he'll say this will prevent a V-shaped recovery. And he thinks that the government is paying people not to work, paying businesses not to be operational. They're paying their rent, their utilities. They're paying for the employees if they don't lay them off in the form of loans that turn into grants. And so that may be true. It is true to some extent. I think we're taking a different point of view. And I've been saying we think this could be a V-shaped recovery, especially because going into this crisis, the economy was extremely strong because of the consumer. And you can even say that about China too. You can see that the Chinese consumer really hadn't skipped much of a beat, and nor had the US consumer. But businesses had been pulling back because they were fearful about the ramifications of the China-US trade conflict. And they were also extremely concerned about the inverted yield curve that occurred last year, and that many economists believed was going to be a harbinger of recession. We did not think that was the case. We do not think this recession has been caused by the inverted yield curve. We believe this shock to the system interrupted what was proving out to be essentially a snapback in the business sector. It was going to be a V shape even without this crisis. Now, if you look at 87 and the 2001 period, what you see is the shock resolved to basically in continuing the trends that had been in place. So in the 80s, we were in a very strong recovery or expansion. And once we got through the shock, that expansion continued. We did see the S&L crisis. There were other problems back then, but the expansion by and large continued. And then in 2001, we were in the middle of the tech and telecom bust and recession, and that continued. So our first instinct was to say, okay, this expansion, the strong expansion that we were seeing, which was going to be joined by the business sector finally, has been interrupted. And if the government hadn't done as much as it has, we'd probably see a very strong V-shaped recovery. I still think we're going to see a V-shape. It may be a little slower off the mark because of government intervention, but I do think something else is going to go on here. We're seeing it all over the place. There are companies, innovators out there who have been disrupting the traditional world order or trying to disrupt it and have a perfect opportunity to accelerate their penetration of the old world and to disrupt legacy players. The reason for that is legacy players are very bureaucratic for the most part, and they're not operating on the most modern technology stacks, which are much more agile, flexible, and are much more distributed. The legacy tech stacks tended to expect companies, employees to be in one place, and even their business continuity plans were designed so that employees would regroup in a place away from the company's main office. We've moved in very quickly to a distributed digital workplace. And we think that a lot of legacy players have been thrown for a loop by this, giving those more nimble, agile, newer players an opportunity to really run circles around some of the legacy players. And so I think that some of the trends that have been in motion are going to accelerate dramatically. I think a lot of people are surprised to learn that online sales in the United States before this crisis were only 15% of total retail sales. We think that's going to accelerate dramatically. I think we thought that we would get to 60%, I think by 2030. We could get to 60% a lot more quickly now that more people have been forced into checking it out, trying it out, and finding how useful it is. We think cord cutting is going to accelerate here as streaming is taking over. A lot of people are saying, well, Disney is certainly a buy down here. And I'm not going to make a judgment call on that right or wrong, because compliance would suggest I not do that right now. But I will say they are hostage to a lot of forces that help us recognize that it really is a legacy player. The cord cutting, the parks are shut. Their studios are very centralized and they're shut down. Interesting, even the movies, and they have wonderful brands. Just talking to our research team at Brainstorm today, that they're saying they're bored with movies, even Disney movies. They're much more into the engaging activities in terms of streaming and Twitch and gaming, other kinds of gaming. So I think even that part of Disney is going to come up short relative to expectations. I don't know if Disney is the company. I do believe, though, that some legacy player out there who we think is impenetrable, has franchises that should endure for all time. It may come up short in a way that will surprise us. And I'm talking about financially short. And we don't know which one that's going to be, but we are on the lookout for it. And that could be one of the biggest surprises and could mark the ultimate bottom in this bottoming process that we're going through right now. And we do think it's a bottoming process as investors try to figure out where the bankruptcies are, where the weak links are in the financial system. And we do think some of those, we've seen them, energy for sure. And now what we're seeing with energy is a severe contraction in capital spending, especially in the United States in the shale oil and natural gas space. And so what that's going to cause, we believe, is extreme volatility in the energy price. So right now, $20, we got down to $20, maybe even sub that per barrel this week. And because of the rapprochement, which may or may not be underway between Saudi Arabia and Russia, we're seeing it spike. So maybe the new range is 20 to 40. We don't know, but we think most of shale oil is uneconomic there. So we'll see tremendous cutbacks there. We also think digital wallets are going to accelerate their penetration of the financial services space as more and more people begin to understand how cash is a super virus spreader, or a virus super spreader. And let's figure out a way to do mobile payments and peer-to-peer and so forth. We also think Square and others, again, PayPal, Venmo, more nimble, are doing things to help those who are in financial straits, including loaning money to these businesses that they know very well because they are able to track them minute by minute. I think in terms of education, we think we're probably going to go online and much faster than I think even we thought. And we do think as more and more people are forced to experiment with it, that it's going to become a big part of our educational system, especially because companies like 2U are going to be working with institutions to lower tuitions now that they're going to be able to get rid of or slim down on the bricks and mortar side of it, like retail has done, and lower the cost of education. That's maybe one of the good news. And in the industrial sector, I think we're going to see a much more rapid shift to robotics, 3D printing. There will be the substitution of capital for labor, especially now that employers are learning that they're on the hook potentially for paying for employees, paying for the paid leave as employees are forced to stay away from work. Now, this time they're going to be reimbursed for it, perhaps, but in the future, who knows? Social distancing is another reason to use robotics increasingly. And the severe shortage of spare parts is yet another reason to move towards 3D printing. And a lot of people are understanding now that for ventilators, 3D printers are helping to replace some of the valves that wear out. And so important use case that many people are discovering for the first time. So I'll end on two notes. One, energy prices being down as low as they are have called into question, some people think, the shift towards electric vehicles. We are not worried at all about this. The total cost of ownership today for an electric vehicle, even at these energy prices, is lower than that of a gas-powered car. And the sticker price is falling consistently, and we think Tesla will accelerate that trend so that the average selling price of an electric vehicle will be below that of the average selling price, like for like, of a gas-powered vehicle. So that's going to happen. What we are focused on in terms of our own forecasting is we believed at one point that in 2024, there would be 37 million electric vehicles sold because of this dynamic. They'd be much cheaper, much easier and to maintain, much more efficient, all kinds of reasons. Now, our forecast is being called into question, not because that shouldn't happen, but because traditional auto manufacturers are in desperate straits here. Auto sales dropped from more than 17 million units in February to 11 million units at an annual rate in March. That is a shock to the system. And so auto companies are going to have to figure out where they are going to cut costs. Are they going to cut their R&D budgets focused on electric? Or are they going to pivot and say, we have got to accelerate this shift away from the internal combustion engine toward electric? We're going to have to really eat our, the business that has been feeding us for so long as we pivot. And can we do this? Well, GM, surprisingly, I couldn't believe this when I saw it, is still paying an 8.4% dividend. That dividend is going away, just like Ford's did. And so they're going to have to make all kinds of sacrifices. Tesla is not going to have to do that. Tesla's entire R&D budget is focused on electric. And we believe it's going to take incredible share of the auto market during the next few years, much more than we originally thought. So we think Tesla, and you saw their production statistics, they were announced overnight, much higher than what most people had expected. And an important reason for that is Shanghai is coming on strong. China is coming on strong. We heard from BMW today that China, they're basically back to full capacity there in China. So we think China is a tailwind for the global economy that many people are forgetting about. So that's some good news there. I do think that Mohamed El-Erian's concerns are valid. There are many companies out there who spent, and Jeff Gundlach would fall into this category as well, who have spent 10 years since the end of the last financial crisis, leveraging up to buy back shares and keep the return on invested capital going for their shareholders who look at that number. We think that's going to prove to have been a mistake because what they should have been doing was investing aggressively to move their companies into the new world. They didn't. And so many of them are going to experience turmoil. As you know, we are not exposed to those kinds of companies at all. We are exposed to the companies who are effectively going to turn the companies who just were repurchasing shares instead of investing. Our companies are going to take advantage of that situation, and we think move ahead of them at a much faster pace than otherwise would have been the case. That said, we would suggest that investors be very careful in terms of allocating their resources, whether in equities or in fixed income. If you look at the fixed income benchmarks, some of the largest issuers are those most at risk. They're junk bonds now. So be very careful. It is a dangerous time for companies who have not invested for the future and have taken on too much leverage for the wrong reasons, we would suggest. So be careful. Stay on the right side of change. We certainly have designed ARK's research process to make sure that we are on the right side of change and stay on the right side of change. So I hope that we're presenting a balanced view here that will help you think through your investment objectives. And we'd love to get your feedback. That really helps us. If we've got an open research ecosystem, we would like you to tell us where you think we are going wrong, because we would like to change our spots if we have not taken enough evidence into consideration. So please do stay in touch, and we'll do the same with you as long as this video seems to be effective and helpful. So thank you very much, and I hope you have a restful weekend after a very active week, I'm sure. Thank you.